Imagine if your money could work as hard as you do. What if I told you there's a way to potentially earn more than your savings account, get paid like clockwork, and have big companies begging to borrow your cash? Sounds crazy, right? Well, buckle up because we're about to uncover the secret world of corporate bonds. Today we're diving into the fascinating world of corporate bonds. Now I know what you're thinking. Bonds? Exciting? Trust me, by the end of this video, you'll see why corporate bonds might just be the unsung hero of your investment portfolio. So, what exactly is a corporate bond? Think of it as an IOU from a company. Companies like Apple, Morgan Stanley, JP Morgan, Microsoft, just to name a few. When you buy a corporate bond, you're essentially lending money to the corporation. In return, they promise to pay you a fixed rate of interest on a regular basis, usually semi-annually, and give you back your original principal when the bond matures, your face value. Let's break it down with a simple present-day example. As of the end of July, you could buy a Bank of America corporate bond. Let's just step aside for a second here. Keep in mind, you're not buying a Bank of America certificate of deposit that's guaranteed by the Federal Deposit Insurance Corporation, or FDIC. If the Bank of America goes bankrupt and defaults on its debt, you could definitely lose some, if not all, of your principal. This Bank of America bond has a $1,000 face value that comes due in about 12 years, September of 2036 to be exact, and Bank of America would pay you 4.05% or $40.50 every year, or actually $20.25 every 6 months. But here's where it gets fascinating. That $1,000 face value bond would cost you $914.45, which means not only is Bank of America paying you money every 6 months, they're also going to turn your $914.45 into $1,000. The combination of those semi-annual interest payments and the additional $85.55 at maturity means the yield on this bond isn't the 4.05% like the stated coupon, but it's actually 5%. It's sort of like buying a dividend stock and not only receiving the dividend, but locking in a guaranteed price increase from $91 a share to $100 a share. Pretty interesting, huh? Unlike stocks, where your returns can be as unpredictable as a cat on catnip, bonds offer some serious stability. When you buy a bond, you know exactly, 1, how much interest you'll receive, 2, when you'll receive it, and 3, when you'll get your face value paid to you. This predictability is sort of like a warm, cozy blanket for your investment portfolio. It can help balance out the wild roller coaster ride of stocks. Stock prices will go up and down, as will bond prices, but if your original intention when buying that Bank of America bond was to hold it until maturity and collect the interest payments along the way and get that bump in your investment at maturity in 12 years, it really doesn't matter what any of the markets do because you're going to get your $40.50 every year and the $1,000 face value in September of 2036. Even through Federal Reserve interest rate cycles where they raise or lower rates, you've locked in your outcome from the beginning. This is the point at which a lot of people get turned off by bonds. We've removed the excitement. We've removed the uncertainty that allows you to dream your $1,000 investment could become $1 million overnight. For those kinds of thrills, I'll pick up a lottery ticket from time to time and imagine the tax-exempt municipal bond portfolio I could build with my $257 million jackpot. However, for the income certainty I need at this point in my life, bonds help me sleep a little better, knowing I've got a regular income coming in. My return is locked in, like a squirrel with its acorn stash for the winter. Let me tell you a quick story about my friend Helen. She always thought bonds were boring, preferring the thrill of trading stocks. One day, she bought some shares in a hot new tech company. The stock soared and Sarah was on cloud 9. But faster than you could say market crash, the company's CEO was caught in a scandal and the stock plummeted. Sarah lost a big chunk of her savings overnight. After that, Sarah decided to give bonds a try. She bought some corporate bonds from established companies as well as some taxable municipals, U.S. government agencies, and even a couple of U.S. treasuries. Now she sleeps better at night knowing that a portion of her portfolio is steadily growing, regardless of market swings. The moral of the story? Don't underestimate the power of predictability in your investment strategy. Now let's talk about an important aspect of corporate bonds: credit rating. Think of credit ratings as a report card for companies. Agencies like Moody's and Standard & Poor's grade companies based on their financial health and their ability to pay debts. The ratings range from AAA, which is top notch, to C, yikes. Bonds rated BBB or higher are considered investment grade, while those below BBB are called high yield or junk bonds. I typically try to stay above A1 by Moody's and A+ by Standard & Poor's. It gives me a little room to maneuver should the company's finances begin to unravel, allowing me to get out without taking gigantic hit. While it could happen, it's highly unlikely that an A1 rated bond will suddenly go into default overnight. You'll typically see it coming as time goes on. Here's a word of caution. While junk bonds might offer higher interest rates, they come with a much higher risk of default. It's like betting a three-legged horse to win the Kentucky Derby. The payoff could be huge, but the odds aren't in your favor. For beginners, it's usually best to stick with investment-grade bonds. Now here's a bonus tip that most beginner investors don't know about. You can actually check the prices of corporate bonds yourself using something called TRACE reporting. TRACE stands for Trade Reporting and Compliance Engine, and it's run by FINRA, the Financial Industry Regulatory Authority. To use TRACE, simply go to the link in the description. Here you can search for specific bonds by their CUSIP number or the company name. This tool gives you real-time trade data, including prices and yields. It's like having a secret window into the bond market, where you can actually see what traders and investors are doing and have done on any specific day. Give it a try. Find a corporate bond that's interesting to you on your favorite platform like Fidelity or Schwab, and plug the CUSIP into the TRACE website to see all of the information they provide. I always check this before I buy a bond. If you're finding this information as juicy as a medium rare steak, why not hit the like button and subscribe? It's free, and unlike the 3-year bond, you don't have to wait years for the payoff. You'll get more great content right away. Now let's address some of the common misconceptions about corporate bonds. One big one is that corporate bonds are risk-free. While they're generally less risky than stocks, there's always a chance that the company could default. That's why diversification is key. Don't put all of your eggs in one corporate basket. Another myth is that bonds are for retirees. Not true. Bonds can be a great addition to any portfolio, regardless of your age. They can provide steady income and help balance out the volatility of stocks. I've personally owned bonds since I was in my 20s, and 30 years later, I have no regrets about that. Here's a pro tip from my 30-plus years in the bond trenches. Always pay attention to the yield curve. The yield curve shows the relationship between a bond's maturity and its yield. Generally, longer-term bonds offer higher yields to compensate for the longer commitment. However, if short-term yields are higher than long-term yields, an inverted yield curve, it could mean there's some value in putting some money in shorter bonds. What's really fascinating is while you may hear on CNBC or Bloomberg television that the Treasury yield curve is inverted, it doesn't always mean the same for corporates or municipal bond markets. While these markets are certainly interrelated, they don't always move in lockstep. So when you're looking to buy bonds, look across product types, like corporates, U.S. government agencies, municipals, to see where there's some additional value and some yield pickup at that moment in time. All right, my friends, we've covered a lot of ground today. If you're intrigued by corporate bonds, but are still feeling a bit nervous about the credit and the default risk, why not check out our video on Treasury bonds? They're like the training wheels of the bond world. Super safe, backed by the U.S. government. We'll put a link at the end of the video if you'd like to watch that one. Remember, investing in corporate bonds can add a layer of stability and predictability to your overall investment portfolio. You know exactly what you're getting and when you're getting it. That's a beautiful thing in an often chaotic world of investing. Before we wrap up, here are some actionable steps you can take. 1. Research some well-known companies and look up their bond offerings. 2. Practice using the TRACE system to check bond prices. 3. Consider buying an individual bond whose maturity coincides with some future cash flow need, like a child going off to college or your retirement. And always remember, while bonds can be a great investment, they're not a one-size-fits-all solution. Always consult with a qualified professional before making investment decisions. Your financial situation is unique, and what works for one investor might not work for another. Until next time, this is Michael O'Donnell saying, always think of bonds if you're looking for an investment where you know exactly what you're going to get and when you're going to get it. Thank you so much for watching.